Hey there! Thanks for joining me. I'm Joe DiSanto, and if you don't know me, I teach people how to master their finances and create lasting wealth. So hopefully you're here for that or something similar to it. I'm doing another Q&A video here, excuse me, and this one is actually asking me to comment on Warren Buffett's, saying at some point or another that intellect wasn't as important as temperament when it came to investing. They wanted to know my thoughts on that, if I was for intellect or for temperament, and also like how does that sort of relate to some topics like dollar cost averaging, leveraging, compounding, investing in high quality companies, and diversifying appropriately. Well, I have to say, and I'm not one to disagree with Warren Buffett, of course, but I would if I could, and on this one I have to agree. I would say temperament is definitely probably the more important factor in successful investing, specifically for the average person, which I consider myself. And when I say that, I mean someone that doesn't work in finance and isn't doing investing for a living for other people. And probably, temperament in this theory would apply to many of them as well. But I think to be, a fund manager of like a multi-billion dollar fund, you have to be quite intellectual as well. But of course, temperament's going to play a part even for those folks. The reason I think that, and or I agree with him, is that it's so easy to make wrong, rash decisions with your investments when crazy things are happening, particularly when the market goes down sharply or for long periods of time. It's very easy to get spooked and go sell at the wrong time. I mean, it really comes down to that. And then what happens is the market starts to go back up. Then you get, fear, FOMO, and you go buy back in higher. So you sold low and you're buying high. Literally the opposite thing you should be doing. But believe it or not, it just easily happens to everyone, including me. Uh, I'm probably definitely apply here. I've pretty decent intellect and I have a lot of knowledge in studying when it comes to investing. But even I, like in the tough times, get scared and often make the wrong decisions with the money that I manage. I will say, as much as I hate to admit it, if I could go back and invest all the money I've ever invested in stocks just in index funds, probably the S&P and NASDAQ, 50-50 or something like that, I would do it. If I do the math, I would have done better doing that. But again, here's a temperament thing. It's hard to do the most basic thing that seems the easiest thing to do. You want to think to yourself, hey, if I do more reading and maybe I can be clever and maybe I can outsmart the market. Maybe I can, get in on that win. And then of course there's always the FOMOs. Things that you hear about, friends are talking about now with social media, everything, if you consume social media content around investing, it's just crazy, FOMO and fear. I mean, that's how they get you to watch stuff. So that's just a yet another big component. So I would say that temperament and realizing what is the smart thing to do and how not to get nervous when things get a little crazy will save you more so than intellect. When it comes to dollar cost averaging, I mean that is a temperament based maneuver. You are basically playing the averages, putting the same amount of money in over time, and buying into the highs and lows and taking the averages along the way. When it comes to leveraging the power of compounding, the more time in the market, the better. Not making crazy moves and taking money out of the market in bad times. Certainly, temperament plays a part in that. Investing in high quality companies. Well, if you play the averages and you invest in, say, the S&P, which is the top 500 companies in America, you're easily investing in quality companies. Now, can you do better by investing in 20 companies that you cherry pick out of there? Motley Fool will tell you yes, but the trick is picking those 20 companies. And even Motley Fool, when they give you their, Motley Fool main basic newsletter list, they have 100 companies in there. and they tell you, invest in these 10 if you're beginning, but those 10 change. So it can be hard to know, the right decision to make. Um, Lastly, diversifying appropriately. Investing in index funds is instant diversification. So it seems like, and of course, Warren Buffett famously said, don't invest in mutual funds or with fund managers, just invest in the market through low cost index funds, and that will beat fund managers like 80% of the time. I'm sure that's true. If he said it, he would know more than me. Like I said, I wish I could go back and do that. Luckily, I preferred real estate for much of my 20s and 30s, so I invested a lot of my free capital in that. And to me, that's easier to understand. And you cannot make rash moves in real estate. You can't get out of real estate quickly. You can't get into it easily or quickly. It really requires a lot of patience and not, allows you to not make irrational decisions like on the spot. So, but you got to diversify. So, of course, I think on the whole, I still did okay in stocks, but if I go back and could just do index funds, I probably would have saved me a lot of grief and I probably would have done even better. Okay, that's all I have for that. I'll talk to you later. Thanks so much.